Greetings. We're going to cover the rest of Chapter 15 as it is in the PowerPoint slide. It's your Chapter 1 of the textbook. We're going to do it through this blended methodology because we've covered the major points already in class when it comes to C corporations and the flow-through entities, all of which is part of the introduction to the chapters to come. So we're going to skip through here, and I just want to stop at this slide. Even though we did it in class, we talked about this mitigating the double tax of, this is C corporations. We talked about it, but I want to emphasize it by an illustration. We did a picture in class of a holding company, and now we're going to do another one of the great pictures from the annals of CPA tax planning. If there was a museum of CPA pictures, this is another one that comes out as a great one, like on the order of the Mona Lisa painting or something like that. But it really is a fantastic one. Let's say this is our owner here. The owner owns two corporations. It owns we'll call it OPS, which is the operating entity, and this one we'll call the RE, real estate, the real estate entity. This one's holding a building. The building happens to be where OPS is doing their business. If OPS has a manufacturing or a wholesale, and they need space with which to store inventory or to build the manufacture of the product, the equipment, and so forth, they're renting from this entity, which will normally be a limited liability company for reasons that we'll get to better when we cover partnerships. So you will learn this picture in and out throughout the course of the semester. At the end of the semester, you'll be able to explain this picture and all of its nuances to your friends and family. For now, you'll get the gist of it and see why it fits in with the concept of mitigating the double tax of C corporations. So here you have your owner. So the owner here is the shareholder of this entity and the owner of the LLC. And there you can see that if OPS has to lease the building, OPS is going to be paying in the direction of the arrow rent. Now, where does this money go? Let's follow the money. This is what forensic accountants do. They just face forensic accounting, by the way, is just basically one simple concept: follow the money. That's really what it is. How you do it and some of the tricks of the trade and the details, that's what courses in forensic accounting are all about. But you're just following the money. So let's follow the money here to see how it works out for tax purposes. The profit started here in OPS or corporation, and it might have been this amount. So of this amount, what we've been able to do is carve out, let's change the color a little bit, carve out two of these and move them in the form of rent to the limited liability company. It's a deduction at OPS, and since it's a deduction at OPS, the rent is an expense. That's why it's a deduction, and it reduces the taxable income, the TI of OPS. It reduces it, which is good because it's now money that is reducing the double taxation. Why? Because it doesn't have to be paid out to the owner as dividend. Why doesn't it have to be paid out to the owner as dividend? Let's complete the picture and the flow of the money. So the money flows to the LLC. Got to get the right color. Don't want to mess up the colors. After all, the color of money should be green. Oops. All right, well, we'll leave it the way it is. Nevertheless, the owner's money from OPS, here, the profit in this entity, has moved in the form of rent to the LLC. And now let's follow the end result. The money will now be paid by the LLC, which is a pass-through or flow-through entity. Hence, it does not have a double tax issue. That's what you should be saying. It's a flow-through entity, no double tax issue. So the money now flows without any fear of double tax back up to the owner, and it ends up here. Oh wow, what a mess of a picture, but a great picture, because instead of having to pay it as a dividend from ops to the owner here, where we have the double tax, one here at the corporation and two at the dividend level, we've got the money coming out to the LLC as a deduction, and it flows through the owner. Now, it's true, one level of tax will be paid. What level? The level will be at number 2, the individual level. That's where the tax will be paid. Here you had the tax paid once here, double tax, and here it'll be just at the individual level, the owner level. But that's okay. We've avoided the double tax. So you can see the beautiful picture that you have here, and if you want to recreate it for your friends, it looks simply like this. You got the owner, you got a C Corp, leasing property from an LLC, so the money follows the direction of, let's do it this way, how do we want to do this? Oh boy. Let's follow the direction of the money in green, so it's the money goes from the C Corp to the LLC and then back up to the owner. Never is any of that money considered a dividend, so it's never after-tax earnings that are paying the dividend. It's deducted here, and we're good to go. Hopefully you follow that. Send me an email if you don't. Let's move forward. And we covered net operating losses in class, and we covered the concept of flow-through entities, that they can pass those net operating losses to their owners, just like they pass or they flow through profits. They also flow through losses as well. So the owners get the benefit of the loss without having, and here's the key, without having to wait for the carryover period. If it's a C Corp and there happens to be a net operating loss, NOL, then you got to wait to offset it against income. Maybe. If you have years you can carry it back, those 2-year carryback, then you get the benefit of it right away by carrying it back, amending the returns, and getting your tax refund then. But if you don't have the 2-year carryback and you can only carry forward the 20, so as a C corporation, you got to wait to get the tax benefit of that, and it's not at the individual level; it's a C corporation level. Whereas with the flow-through entity, if it's a flow-through, let's call it an S corp or LLC, they're both that way. The losses may go to the owners and be used against other income that the owners have. And so even though no one wants to lose money, the owners are happy because they save tax dollars currently at that time. So that's the concept with this ability to deduct the flow-through losses against other sources of income. We will get into this in a big way when we get to partnerships and S-corps. Here's an example. Let's see what they do here. Here we got good old Nicole again, organizing a corporation. First as a C corporation. See that? C corporation. And in spite of her best efforts, oops, it loses money. Recall that her rate is 35%. That's her rate. And that she will have ordinary income of $200,000 from her husband. There you go. In this case, it's reverse of our in-class example. The husband's making the money and the wife lost in her C corporation. How much tax will CCS have to pay in year 1, and how much tax will Nicole and her husband, if they file jointly, have to pay on the $200,000 of taxable income that the husband brings to the joint return? So let's get a lay of the question over here. You've got the C Corp. Let's see, the C Corp lost money. How much? They lost 50 grand. Losses, 50K. You got the husband and wife, call it H and W. Maybe we have to change part of it though, because it's Nicole, so we'll call it H and N. Almost sounds like a department store. Harry and Nicole. He makes $200,000. She doesn't earn any money yet because her corporation is losing money. And as a C corporation, this loss is frozen up here at the C corporation. It does not pass through to H&N's joint return. Harry and Nicole's joint return. Now let's change the circumstances, and we'll go back and let's draw it this way now. It's an S Corp. Now the $50K loss is a flow-through. So it flows through for tax purposes to the individual return and gets reported on the tax return as a $50K loss. Ooh, really cool. Now we got $150 subject to tax. And so the net result is that Harry and Nicole will save taxes immediately. In the C Corp example, it was the first year. There's nothing to carry back to. You got to wait till it earns money. And who knows when that will be. In fact, let's look at it this way one more time. Where are we going to do this? Let's do this down here. We've got plenty of room here. Let's say it's the C Corp's first year. Year one. And it loses $50K. There's no place to carry it back, so that's a no-go. But you can carry it for 20 years. What if you never earn any money? What if the place closes down the next year? What if Nicole comes back, what was I trying to draw there? What if Nicole comes back to her husband and says, we lost $50,000 in the first year, and her husband says, that's it? You pardon this example, you close that business or I'm divorcing you. So she closes the business. End of story. No second year. This $50K loss is lost. L-O-S-T. There's no place it goes. It's just lost. No tax benefit. That is unacceptable. No tax benefit. So that's where I said we get creative as accountants and come up with some method to avail ourselves of that loss before closing that corporation. Okay, so let's see. The answer was the corporation will pay zero taxes because it reports a loss. Because Nicole may not use it when it's a C corporation, the example was C corporation, to offset her other income, she must pay $70,000 in taxes on the whole amount. However, had she been a flow-through entity, and here's the example as a flow-through entity, so go through these carefully on your own. If she had been an S corporation, then Nicole's base, and she's got bases, we'll learn about that in more detail when we get to S corporations. How much tax will she pay? So let's take a look at the answer. Again, the corporation, S corporations pay zero tax. S corporations are not tax-paying entities. They're flow-through. Remember we said that? Flow-through. They pay no tax. All of its income or losses get passed to the individual owners. And now Nicole pays only $52,500 in taxes. Why? Because, let's see, does this do it? Yes, it does it. It explains it. Here's her example as an S corporation. She pays less taxes. It's not the same number as over in here in this slide. I guess they changed the rate somewhere along the line. But you get the picture. Here's her income from her husband. Here's the loss that flows through to her, net taxable at their individual rate there. Meanwhile, had it been a C corporation in its first year with no carryback, this loss is suspended until income happens in the forward years, the future years, if at all, and so she pays more taxes. There's no benefit of that loss that year. And that's a big part of the game of planning for flow-through entities, making use of those losses when they happen for the individuals. Really cool. Okay, what if, so, one more example. Now, CCS is organized as an S corporation, and Nicole's bases. All right, so this gets into bases issue, which we'll get into when we get to that chapter. But just for purposes of understanding the example, what's going to happen here is since she, before the 50,000 year one loss, okay, so let's get to the way. She's an S corporation. Let's get the facts. Her basis in the S corporation before the 50 is 100,000, so that's good. But she doesn't participate. There's a participation element in the business activities, because if you don't participate, you become a passive investor in the business entity. So if you're a passive investor, what happens is that the flow-through doesn't help. The flow-through doesn't help. So here, let's read this. Because Nicole is a passive investor, she's not allowed to deduct the loss. So what is a passive investor? Passive investor is someone who owns the company or part of the company. It's an owner who is not employed or simply who doesn't really work for the entity. They're passive. Doesn't work for the entity. Now they can spend some time working for the entity, but there are rules of how much time that should be. The common rule is it's got to be greater than 500 hours in order to establish that it's not passive. But there's a series of 7 rules, which we'll do when we get to flow-through entities, specifically in the book. So that'll get, but for now it's just an introduction to let you know that it's not true that all losses in flow-through entities can be passed through. You're going to have to meet criteria in order to allow the flow-through. So losses are subject to rules as to when they can flow through. One rule is the basis that we've learned about now. That's one. Got to have basis, and you see in these examples it talks about basis and says she has basis. Second rule is got to be active, not passive. That's the corollary, not passive in the investment, in the company. For now, then, just get the gist of what we're talking about. The details will come later as to what all this means. And finally, not only does they have to have basis and be active, but finally, run out of room here, I think, so go over here. Finally, the third test is they have to have risk. So there's going to be 3 tests. Number 1, basis. Number 2, active. And number 3, risk. That's reserved for a later chapter in much more detail. All right, so let's see. Entity tax characteristics. As you see here, you see this is telling you there's going to be future chapters discussing all these details that are introduced to you in Chapter 15. And that's why I said to you that truly we ought to start at Chapter 16 and move forward, go through all the entities and the details, and then come back to Chapter 15 and tie it all together. And I think there will be some aspect of that as we go through the semester where we're tying it back. Let's see, entity converting to other entity types. C corporations can convert to S. We talked about that in class already. We will get into liquidation in a chapter very soon. But this is a good statement to know. They may liquidate and form as an entity tax as a partnership, but there's a tax cost to liquidation. There's a whole chapter on that. Entities taxed as partnerships here or sole proprietorships. They're not double taxed, so they're tax-free, and they very common before an IPO. Once you go IPO, once you're going to do an IPO, then you have to become that C corp that we spoke about in class. And that is that. So I think we did a good job of going through Chapter 15 in class, and that this little supplemental video just puts the icing on the cake. That way we can start off fresh next Wednesday with Chapter 3 in your book. Chapter 2 in your book, which should be correlating to Chapter 16 of the full textbook. I have the book in front of me right now, so let me just verify that it's Chapter 2. For you, it's Chapter 2, called Corporate Operations. I look forward to seeing you then. Have a great holiday.